Equity Bank in Kenya has announced that it's already positioning its network of 190 branches into centers of providing advisory and consultation services for SMEs and large customers as retail clients shift to digital channels. In its third quarter financial results released early in the week, Equity Bank announced that legacy banking, that's physical branch networks and ATMs, now account for only 3% of the bank's total transactions. 945 million transactions were carried out on mobile devices or on third-party infrastructure. Damilola Olupona, who's an analyst with Chapel Hill Denham, joins us now to discuss further. Dami, thanks for joining us. I guess for banks, physical banks that see more transactions move online, is it a natural transition to want to now say you have to meet the customers where they are, or how do you see it?
Yes, it is. Over time, our view has always been that banking will move from the normal brick and mortar, to the digital space. And indeed, we've started seeing that come to fruition. If you look at the financials, of most banks, especially the Nigerian banks we cover, most of them are investing, in the digital space. Just to mention a few, GT Co, part of his holding structure is to have a fintech-focused subsidiary, that will cater to the digital needs of their customers. We've also seen other banks like, First Bank, also tilt, their focus, towards the digital banking space. And if you even look at the fee and commission income, we are beginning to see expansion, in e-bank, electronic banking revenues, which speaks to, the banks, just shifting their focus, to the digital space. And this strategy is not far-fetched. If you look at the mobile phones, penetration rate, currently, the African countries are currently at the bottom of the pie. But what we've noticed over time is an increase, which speaks to more adoption, of internet and also digital devices. And it just means that there is a market, for financial institutions, who look to pitch their tent, in the digital banking space.
Are financial institutions set to save money by switching from physical to a more digital avenue for customers?
Yes, they do. They save money. As you know, if you strip out the financials of banks, one of the major cost area is the operating expenses. And aside the staff cost, you would see other operational running costs, which are also sizable, in the scheme of things. And if banks shift their focus to the digital banking space, then the operating costs, emanating from the cost of running a bank branch or the cost of diesel costs and other related costs, that come with setting up physical presence, those costs will be eliminated. And in terms of cost savings, it will come back to the company as earnings, which is also good for investors because these earnings might also translate to higher dividends and might also translate to more product offerings as well. So I think it's a big win, for banks, whichever way you look at it. And over time, even in Nigeria, I think we'll see more banks, embrace the digital banking space.
Excellent. Now, speaking of big wins, you mentioned GTCO, for example, focusing on the fintech division and so on. This switch, is it a win for fintechs, or are banks, obviously, if they're going to be switching their strategies towards that end, are they going to be able to compete, there?
The way I see it, I think the market is big enough for everybody because if you look at the financial inclusion rate is still somewhat low. There is still grounds to cover. So to that end, I think both the fintech players and the banks, still have a lot of grounds to cover. And it just depends on who is aggressive the most, and who is able to have dominance, on that market. Yeah. But for me, I don't think the fintech players are entirely a threat, although they are. But I think looking at the size of the market, and especially the unbanked, I think both the banks and the fintech players can play amicably in the market.
Interesting. It's going to be very interesting to see how things play out. Credit to the private sector from the banks. What do you make of the growth that we've seen year on year?
Yeah, on a year-on-year basis, it has grown, and the reason is not far-fetched. Nigeria was the least with COVID-19 pandemic last year, and that sort of moderated, expansion of credit, to the private sector, as it was largely uncertain, what the devastation to the economy would be, from the COVID-19. But now that we are beginning to see the economy tilt towards normalization, what we are beginning to see is, more banks, increase their loan growth, particularly in the third quarter of the year. We've seen banks like Zenith banks and, some of the banks, we cover, just report higher loan growth, which also speaks to the expansion of credit to the private sector, like you reported. And one other thing is, if you look at the bank earnings this year, most banks have struggled to replicate the impressive feat, that was reported last year in terms of interest income, coming from investment securities. Banks are beginning to realize that they need to pinch their tent, outside of investment securities, and we are beginning to see banks, just ramp up borrowings, to the private sector to earn some interest income in that space. But overall, we view this as positive because the credit to the private sector would further enhance Nigeria's growth. And also, I think it's also a right direction, for the banks as well, as it might translate to higher earnings, in terms of interest income as well.
Great stuff. I think about a minute or so to go. I want to ask you about non-performing loans. As credit is rising to the private sector, what about the risk of the increase? Although it looks like the banks have done well, keeping their non-performing loans low. What's your take on? Yeah,
the banks have done well, but a lot of the credit, goes to the central bank. The central bank has extended the forbearance, they've granted to most banks or to troubled areas in the economy. They've extended that to 2022. And for me, I think that has masked the true picture of Nigeria's asset quality. So at the moment, they're somewhat low, as at half year, across our coverage banks, NPL ratios were somewhere around 5%, which is impressive, even lower than the 6%, reported at full year 2020. But then if we see the economy, return faster to normalization, I think that trend might be sustained. But if we see further shocks, to key sectors like the oil and gas and the manufacturing sector, which account for bulk of the banking sector exposures, then we might see further pressure emanate. But currently, as we speak, the bank is in a comfortable position, as regards asset quality.
Damilola Olupona, analyst with Chapel Hill Denham. Thank you so much for joining us to talk about the banking sector.
Thank you.